Hello and welcome back to another episode of Market Brief After Hours. Today was one of those days where looking at the headline numbers only tells you half the story. We're seeing a very distinct shift in behavior on Wall Street, a rotation really, where money is moving out of the high-flying tech names and parking itself in more traditional industrial sectors.
It certainly was a fascinating session. If you just glanced at the S&P 500, you might think nothing happened. But under the hood, there was a lot of turbulence. We are seeing investors rebalancing their portfolios, moving away from artificial intelligence and large-cap technology and pivoting hard into energy, defense, and industrials. It's a classic rotation trade, driven by valuations, geopolitical headlines, and perhaps a bit of profit-taking in the tech sector.
Let's get right into the scoreboard, because as you mentioned, the divergence between the indices was pretty stark. How did the major averages finish up?
So looking at the closing figures, we had the Dow Jones Industrial Average leading the pack. It finished firmly higher, up about 0.55%. In points, that's a gain of 270 points, closing right at 49,266. It was really the standout performer, rebounding nicely after slipping earlier in the week.
And that strength in the Dow really highlights that shift toward industrial names you mentioned. But the broader market was a bit quieter.
Exactly. The S&P 500 was essentially flat. It edged up just 0.01%, statistically barely moving to close at 69.21. But that flat number masks the internal fight between the sectors. You had energy and defense pulling it up, and tech dragging it down. And speaking of tech, that's where the pain was. The Nasdaq composite slipped 0.44%, closing at 23,480.
Right, so the Nasdaq takes the hit as the selling pressure persists. What exactly is dragging the tech sector down right now? It feels like just yesterday, AI was the only thing anyone wanted to talk about.
The selling in large-cap tech is becoming a bit of a trend this week. We saw NVIDIA down more than 2%, Oracle dropping nearly 2%, and Apple extended its losing streak to 7 consecutive sessions. It seems investors are reassessing the valuations there, especially with yields creeping up, which we'll get to in a moment. But while tech was selling off, the old economy stocks were roaring back.
Let's widen the lens a bit before we dive deeper into those sectors. How did the international markets handle this rotation? Was Europe seeing the same dynamic?
Europe was a mixed bag, but with a very specific theme: defense. The broader Stoxx 600 was actually down about 0.2%, but defense stocks rallied for a fifth straight day. Looking at the country-specific indices, the UK's FTSE 100 slipped just a fraction, down 0.04%. Meanwhile, France's CAC 40 managed a small gain of 0.12%.
And Germany and Italy?
Germany's DAX was essentially flat, edging up just 0.02% to close at 25,127. Italy's FTSE MIB performed a bit better, gaining 0.25% to finish at 45,672. The Swiss market also added about 0.2%. The big driver in Europe was really the chatter around U.S. military spending, which lifted the aerospace and defense sector there by over 1%.
Moving over to Asia, it looked like a tougher day, particularly for Japan.
Absolutely. Japan led the losses in the region. The Nikkei 225 fell 1.63%, and that was largely due to the same tech weakness we saw in the U.S. SoftBank plunged over 7%, and Tokyo Electron was down about 4%. It was a bad day for semiconductor-linked names globally. Hong Kong also struggled, with the Hang Seng dropping nearly 1.6%, dragged down by tech giants like Lenovo and Baidu.
So, the tech sell-off is truly global. Now, you mentioned yields earlier. We saw some movement in the bond market as well, likely positioning ahead of the jobs data.
That's right. Treasury yields moved higher across the curve. The benchmark 10-year yield climbed more than 4 basis points to sit at 4.183%. The 2-year was also up, hitting 3.492%. Investors are looking ahead to the labor market data, but we also got some interesting economic prints today regarding productivity.
Yes, the productivity numbers looked surprisingly strong.
They were very strong. U.S. non-farm productivity surged 4.9% in the third quarter. At the same time, unit labor costs fell 1.9%. This is the Goldilocks scenario for the Fed: high productivity and easing cost pressures. We also saw initial jobless claims rise slightly to 208,000, which is still quite low, and layoff announcements for December were the lowest since July. So despite the tech wobbles, the underlying economy looks resilient.
It's a complex picture: strong economy, rising yields, and sector rotation. We're going to take a very short break. When we come back, we're going to look at the massive moves in the commodity markets. Oil is making a comeback, and we'll do a deep dive into the Forex markets with those key technical levels you need to watch. Stay with us. Welcome back to Market Brief After Hours. Before the break, we were discussing the equity markets and the rotation into energy. That rotation wasn't happening in a vacuum. Crude oil prices really took off today.
They certainly did. After a couple of days of declines, oil came roaring back. Brent crude surged nearly 5%, up $2.96, to settle at $62.92 per barrel. WTI crude was right there with it, gaining over 4.6% to close at $58.61.
That is a significant one-day move. What sparked the rally?
It's geopolitics and supply fears returning to the forefront. Investors are reacting to developments in Venezuela, specifically the U.S. seizure of Venezuela-linked oil tankers. On top of that, there are renewed worries about potential supply disruptions from Russia and Iraq. When you combine those supply threats with the economic resilience we just talked about, it lights a fire under energy prices.
And that obviously fed into the stock market, which we'll touch on in the Market Movers segment. But first, let's look at precious metals. Gold seems to be ignoring the higher yields and just keeping on its path.
Gold is showing incredible strength. Usually higher yields are a headwind for non-yielding assets like gold, but bullish momentum is persisting. Gold settled at $4,475, up 0.44%. Technically, it's looking very robust. The price is comfortably above its 50-day moving average of $4,209 and the 100-day at $3,888. It's firmly in an uptrend.
Silver, on the other hand, had a bit of a rougher session.
It did. Silver fell 1.63% to close at $76.91. But we have to keep this in context. It recently surged to multi-year highs, so this looks like aggressive profit-taking. Despite the drop, the technicals are still intact. It's well above the 50-day average of $59.50. So while it was a sharp rejection from the highs, the broader uptrend hasn't failed yet.
Let's shift gears to the currency markets. For our Forex traders out there, there's a lot of technical action happening. Let's start with the euro against the dollar.
The euro USD is under a bit of pressure. It closed down 0.17% at 1.1654. The key here is that sellers seem to be regaining control. The pair finished below the 100-day simple moving average, which sits at 1.1664. However, it's clinging on just above the 50-day average at 1.1641.
So that 1.1641 level is the line in the sand right now.
Exactly. A sustained hold above that keeps the recovery hopes alive. But if it breaks lower, the next major support isn't until the 200-day average down at 1.1562. The 1.1700 level is acting as a very stiff ceiling for any rallies.
What about the British pound? We saw it pull back recently.
GBP USD is consolidating. It closed down slightly at 1.3437. It's cooling off after a rally, but the medium-term outlook is still constructive. It's trading above all the key averages, the 50-day at 1.3286, the 100-day at 1.3369, and the 200-day at 1.3386. As long as it holds that moving average zone around 1.3380, this looks like profit-taking rather than a reversal.
And finally, Aussie dollar?
Similar story. Aussie USD dipped 0.33% to 0.6697. But looking at the chart, the trend structure is firm. It's trading well above the 50-day SMA of 0.6588 and the 200-day at 0.6510. All the averages are aligned positively. It just stalled near recent highs, which is natural.
All right, let's bring it back to the equities and talk about specific winners and losers today. We mentioned the sector rotation, but which companies specifically were moving the needle?
Let's start with the losers, because the selling in chips was aggressive. Seagate Technology was the worst performer in the S&P 500, dropping nearly 8%. Western Digital fell over 6%, and Micron, Intel, and Broadcom were all down more than 3%. It was a broad-based exit from semiconductors.
And it wasn't just hardware, right? Software took a hit too.
Correct. We saw Datadog drop more than 7% and Autodesk decline over 5%. It was a risk-off day for high-growth software names.
But on the flip side, the defense sector was on fire.
Huge moves there. This was triggered by President Trump signaling a massive increase in military spending, roughly a 50% increase to $1.5 trillion by 2027. AeroVironment surged more than 8%, Huntington Ingalls gained over 6%, and Lockheed Martin climbed more than 4%. When the budget expands that much, these stocks tend to fly.
And with oil up nearly 5%, the energy stocks must have had a banner day.
They did. APA Corp led the S&P 500 gainers, surging more than 8%. Diamondback Energy rose more than 5%, and we saw big names like Halliburton and ConocoPhillips gaining over 5% as well. It was a great day to be long energy.
One retail name caught my eye as well, Costco.
Yes, Costco is proving the consumer is still there if the value is right. The stock advanced more than 3%. They reported December comparable sales rose 6.3%, which handily beat the expectations of 4.4%. Just a solid performance from a solid company.
So to wrap this up, we have a market that is constructive but becoming very selective. We aren't seeing broad-based selling, but rather a reshuffling of the deck.
That's the perfect way to put it. It's not a market crash, it's a rotation. Investors are taking profits in extended tech valuations and moving into cyclicals, defense, and energy. With yields firming and labor data looking stable, the market isn't panicking. It's just repositioning for the new year. All eyes now turn to the upcoming jobs data to see if this economic resilience holds.
We will certainly be watching that closely. That brings us to the end of today's deep dive. If you found this useful, please follow Market Brief After Hours on your favorite podcast platform so you never miss an episode.